At first, it looks like the plan is working. Interest rates go up, headlines calm down, inflation numbers dip for a few months. Central bankers step up to podiums, adjust their glasses, and say the hard part is over. And then, quietly, it comes back. Not all at once, not with a bang, just a little higher than expected, a little stickier than promised, a little more stubborn than the model said it would be. By the time anyone admits it, inflation is already back in the room. That's the uncomfortable truth we're dealing with right now. Inflation doesn't really die. It retreats, regroups, and returns. And the reason it keeps coming back has less to do with greedy companies or reckless consumers, and much more to do with how the modern economic system actually works. Let's walk through it. Because once you see the machinery underneath, rate hikes start to look less like a cure and more like a delay tactic. For most people, inflation feels simple. Prices go up because demand is high, so the central bank raises rates. Borrowing slows, spending cools, prices fall. End of story. That story worked pretty well in the 1980s, back when economies were simpler, supply chains were shorter, debt levels were lower, and money moved slower. But the economy we live in now is a very different animal. Today, inflation doesn't come from one place. It comes from layers. Energy, housing, labor shortages, government deficits, corporate pricing power, financial markets, global trade fractures. Raising interest rates only hits some of those layers. The rest keep burning underneath. And sometimes rate hikes actually make them worse. To understand why inflation keeps returning, we need to start with a basic but uncomfortable idea. Modern inflation isn't just a demand problem, it's a system problem. When central banks raise interest rates, they are pulling on one lever in a machine with dozens of moving parts. That lever mainly affects credit, mortgages, car loans, corporate borrowing, speculative investment. It slows things that depend on cheap money. But what if inflation isn't being driven by borrowing? What if it's being driven by constraints? Take housing. Rates go up. Mortgage payments explode. Demand cools. In theory, home prices should fall. But in practice, something else happens. Homeowners who locked in low rates years ago don't sell. Builders can't finance new projects cheaply. Housing supply stays tight. So rents keep rising. And rent inflation doesn't care how high rates are. People still need somewhere to live. The rate hike hits demand, but it also strangles supply. That's the first paradox. Now look at energy. Oil prices aren't set by interest rates. They're set by geopolitics, production capacity, and global demand. Rates can slow an economy, sure, but they don't magically create more oil, more refineries, or more energy infrastructure. In fact, higher rates often delay investment in new energy projects, which keeps supply tight, which keeps prices volatile. Again, inflation pressures survives the rate hike. Then there's labor. Central banks like to talk about cooling the labor market. That's a polite way of saying they want unemployment to rise, because when workers feel less secure, wage growth slows. But here's the problem. In many countries, labor shortages are structural. Aging populations, lower immigration, skill mismatches. You can raise rates all you want. Those trends don't reverse. So wages keep creeping up, and businesses pass those costs on. Not because they're evil, because that's how math works. This is where inflation stops looking like a fever and starts looking like a chronic condition. You can suppress it, you can manage it, but you can't shock it into submission without breaking something else. And that something else is usually debt. Modern economies are built on debt. Government debt, corporate debt, household debt. Raising interest rates increases the cost of servicing all of it. For governments, that means higher interest payments, which means bigger deficits, which means more borrowing. So the very tool used to fight inflation quietly feeds another inflationary force, fiscal pressure. At some point, governments face a choice: cut spending, raise taxes, or borrow more. History tells us which one usually wins. This is where things get awkward for central banks. They say they're independent, they say they'll do whatever it takes, but they operate inside political and financial reality. Raise rates too high for too long, and you don't just slow inflation, you destabilize banks, pension funds, housing markets, and governments themselves. We've already seen hints of this: sudden bank failures, emergency lending facilities, quiet bailouts dressed up as liquidity support. Every time something breaks, policy loosens just enough to stop the bleeding, and inflation notices. There's also the global angle. In a tightly connected world, one country's rate hikes don't stay contained. Higher U.S. rates strengthen the dollar. That makes imports cheaper for Americans, but more expensive for everyone else. Emerging markets feel the squeeze. They raise rates too. Growth slows, currencies wobble. Eventually, something gives. And when global growth stumbles, supply chains fracture again. Prices rise not because demand is hot, but because the system is brittle. This is why inflation today feels so strange. It doesn't surge straight up. It pulses. It fades, then flares, cools, then creeps back. Central banks declare progress, then quietly revise forecasts upward, again and again. There's also a psychological layer we don't talk about enough. Once people experience inflation, they remember it. Workers negotiate harder. Companies raise prices faster, just in case. Consumers rush purchases before prices climb again. Inflation expectations don't reset easily. They linger. And expectations themselves can be inflationary. So when rates finally start to come down, as they eventually must, the system is already primed. Debt costs fall. Spending rebounds. Investment returns. But the structural pressures never left. And inflation comes back. Not as a surprise, but as a consequence. This is the part nobody likes to say out loud.